Hello, everyone. This is Lucas Caceres with Level Up Financial Planning, and today I'm going to be speaking to you about pros and cons of restricted stock units, also known as RSUs. And the reason why I'm talking about this subject is I just know that there's a lot of confusion around how they work, and a lot of times people are not familiar necessarily with the cons of owning these types of assets. Make no mistake, though, it's definitely way more important and valuable to have restricted stock units than not having them. It's just once you become owner, some of the things that you need to be concerned about and be aware of. Let's focus first on the pro side. The reason why employers offer this is because it does kind of align the employee with the company as far as trying to make the company as best as they can to be profitable and a great place. Additional compensation, that's obviously always a good pro. Looking at how the shares vest automatically, that's just a great feature because it makes sure that there's no possibility that you could forget about the restricted stock units you've been awarded and then they expire valueless, basically. I mentioned that they're unlike non-qualified stock options. That's how non-qualified stock options work. You're granted the shares, but then it's up to you to basically decide if and when you want to exercise those shares. And if you waited too long, they could expire, or if the value fell below the strike price, then they wouldn't make sense. And I do know a lot of people just didn't understand how non-qualified stock options worked and didn't understand them and never took a look at them. And so that's one of the nice things about restricted stock units is it gets one of those additional steps and you don't really have to worry about them expiring valueless, at least as a result of forgetting about them. If the employer stock rises, that's something that could be a good thing for you, being the owner of the grants. And just for an example, using $50 at the date they're granted, saying today in 2018, the employer stock is $50. But next year, that same employer stock, when that first kind of section of your grant begins the vest, it's $75. Well, that's a significant increase, and that's nice to kind of have the possibility of having. There's also always the possibility it could go down. I'll talk to that more in just a bit. It's also a nice automatic investing tool that gives people exposure to how investments could work. I'm thinking more from the lines of younger employees, younger investors who maybe haven't fully dived into what investing in the stock market or various investments would look like. This kind of gives them that automatic toe in the water to kind of see how it works and see what happens when the market goes up and down, and realize that it does both, and it does both pretty regularly. I think is a good way of educating younger employees on just kind of what to expect from investments moving forward. So on the con side, again, it's always preferable to have this additional compensation than it is not to, but once you own it, there are some cons that you should be aware of. The fact that they do vest automatically does force a taxable event, so more impactful for people with higher income tax brackets, obviously, forcing them to pay a lot more taxes on that. It's also a very real possibility that even though the stock value could go up for your employer stock, it could also fall, and which means that same $50 stock that we were granted in 2018 could look like $25 next year. It could look like $5. And there's always the possibility that companies could go bankrupt and things of that nature as well. So just understanding that there's no guarantee that the stock market's always going to go up or down in any specific year. And that's something to be aware of as well. So if you're planning to use all these funds to help pay for a vehicle each year or whatever it happens to be, just understand that you may have to make some adjustments to that plan because the stock market may not match up entirely with your grants and the value that your shares are being vested at each year. Another important thing that people must realize is owning employer stock is a really undiversified asset. Not only is your employer the one that gives you a paycheck every couple weeks, depending on how your payments are structured, but also owning a significant amount of employer stock means that you have a lot more exposure than just being an employee and a lot more exposure than just being a stock owner of that company. In the short term, it's not really going to be too big of an issue because it'll be just a very small portion of your wealth. But over the long term, if you just never sell your shares and they keep vesting, that could end up being a large portion of your wealth and start to increase a lot of risk, a lot of volatility, and realistically, it's just overexposure to any one company that I would always recommend my clients to remove themselves from. And that starts to become more of an issue over that midterm, long term of multiple years of the employer stock building up. Another thing that it's always important to remember is just because you're granted the shares doesn't mean that you'll still be with the company by the time they all vest. So if you were to leave the company, any unvested shares would be lost at termination. I hope this was helpful. I'll record another video or two on specific strategies you may want to utilize. And yeah, feel free to reach out if you have any questions.